Good afternoon, everybody. Uneducated Economist here. So the mortgage markets, they're spiraling out of control right now. There is a lot of stuff happening behind the scenes right now that a lot of people I don't think are quite aware of on how damaging this is going to be to the mortgage markets. And I'm going to try and explain what's going on here as easily as I can, but it's a very complicated thing that's taken place because it starts off with the Federal Reserve buying these mortgage-backed securities. It also has to do with the forbearance that the government has basically issued out there, saying that people can hold back on making their payments for 3 months up to a year. And this is causing like a big whirlwind of problems within the mortgage markets. So to kind of put it simply, we talked a little bit about this before, where these mortgage issuers, right? These are the people who package up these mortgage-backed securities. They got into trouble when the Federal Reserve started buying mortgage-backed securities. Now, you would think it would be counterintuitive. So you'd think it would be kind of counterintuitive that if the Federal Reserve buying mortgages, that would be like a good thing for the mortgage-backed security providers, these mortgage lenders. Because what these mortgage lenders do is that when you sign the bottom line on your loan, they package that loan up with a bunch of other loans and sell that off as a mortgage-backed security. The mortgage-backed security, from the time that they are able to get you to sign the bottom line to the time that they are able to sell it, can be a difference when the interest rates change. So if the interest rates go up from the time that they issue you the loan to the time they're able to sell the mortgage-backed security, they're going to be out of money, these these mortgage lenders. Because when, just like a bond, if the interest rates go up, the mortgage-backed security, the price of that goes down. So what they do is they hedge against that to protect themselves in case the interest rates change. Now, typically it's not a big deal. But when there is a dramatic change, like with the Federal Reserve buying up an intense amount of these mortgage-backed securities, these MBSs, when there is a major change to the markets, when you have these interest rates change, that can really screw with the hedge. And now what happens is that typically these mortgage-backed security providers, they're mortgage lenders. They're like the non-bank banks. They're not really banks. They're just like businesses. When they buy that hedge, it's like its own product. It's something that is marketable. They could sell it or trade it or do whatever they wanted with it. And when they buy that thing, they buy it on margin, meaning they put up a little bit of money to buy this particular product, this hedge. So when the mortgage-backed securities started getting purchased up by the Federal Reserve, and it was a lot of them. I mean, we're talking like, I think, I got an article, I'll leave in the description for you guys, but I believe they said like in the 2010, or from 2009 to 2010, when the Federal Reserve was buying up mortgage-backed securities, the biggest week that they purchased was like $130 billion worth. The end of March, there was a week in there where they made $180-something billion worth of purchases that month. It was like $50 billion more than any other week that they have ever done as far as mortgage-backed security purchases. So they bought a lot of them. And when you have a big buyer of them, the price goes up and the interest rates drop, which is what they were trying to do to get everybody to feel confident to go out there and start borrowing money again to buy a house or whatever. They were just trying to add some price stability or strength to this mortgage-backed securities. But that really screwed the mortgage lenders, because what they ended up with that on that hedge is that the brokers who issue that hedge did a margin call on them, saying that, hey, this product that you just bought, this insurance, basically this insurance product, just dropped in price, and you bought it on margin, and you need to pay up because the product that you're using for collateral is falling in price. And so these mortgage lenders are like, hey, we're going to go bankrupt if you, the Federal Reserve, keep buying these mortgage-backed securities. You can't be doing this. So that screwed the mortgage lenders. The government went and told a bunch of people, or at least this is what they're thinking anyway, that you do not have to make your mortgage payment for a while. Now, the mortgage servicers, who is different, than the mortgage lenders, right? These are guys who are processing the payments. They still have to provide the payments to the mortgage-backed security investors. So you got three different entities there, right? You got the lenders who basically build the mortgage-backed security. You got the servicers who are basically the ones who are processing the payments from people paying making their payments, and then sending that off to the investors who are the ones who are buying the mortgage-backed security. So even though the Federal Reserve is buying a bunch of these mortgage-backed securities are typically bought by investors, like the real estate investment trusts. And now these real estate investment trusts, they're getting screwed because they're not going to be getting their payments if the mortgage servicers end up going bankrupt. You see what's happening here? And so these mortgage-backed security investors, these REITs, when they bought those mortgages, they bought those things on margin. So if those things start to drop in price, they're going to get a margin call as well. So you see how this is causing this big whirlwind, this spiraling effect? It's a very convoluted process that's taken place, and it is very complicated to try and wrap your head around. But if these mortgage-backed securities continue to get purchased by the Federal Reserve, screwing the mortgage lenders on their hedge, which is going to cause them to go bankrupt. They're going to ask for more and more, either interest rates or fees or whatever it is, because they don't know whether or not the Federal Reserve is going to continue to buy these things and if they can hedge their bet against it. Then on top of it, if people continue to go into forbearance on their mortgages, the mortgage servicers are going to go bankrupt to provide the payments to the mortgage-backed securities for those investors who are buying them. And if that starts to drop in price, then the REITs, the real estate investment trusts, the companies who invested in those mortgage-backed securities, they're going to get screwed because they bought those mortgages on margin, and if the price of those mortgage-backed securities start to drop, they're going to get a margin call, and they will go bankrupt as well. Or end up losing out, or however it works. They're going to have to dump their securities, their mortgage-backed securities, start going into a sell-off. So this is creating one heck of a whirlwind of problems. Anyway, Uneducated Economist. I'll leave links down in the description. You guys let me know.